Hey guys, welcome back to the channel. In this video, we are going to share with you what we think are some of the biggest red flags in companies. Guys, as usual, none of what we say is financial advice, purely educational, and we do not own any shares mentioned on the slides. Now guys, if you're really interested in building a 6 to 7 figure portfolio, we've got the perfect solution for you. Head over in the comment section or the description to sign up for our free masterclass where you can get all these proven steps to achieve it. Okay, Jonathan, so red flag. So I think before I begin, one of the things I want to start off by saying is, I think when a lot of people come into the stock market, they're always asking what stock to buy, what are the criteria to pick a stock, what, things like that, which is obviously a good thing to figure out. However, sometimes what is a good stock can be quite a challenge because business model changes. Good business model changes. Correct. Right? Like what is good, in the past is maybe strong cash flow, right? Strong cash flow and consistent. Okay, great. But then adding to that, growth is also important. Valuation is also important. Well, good management is important. How do you value good management? Well, they need to have this, they need to, not overspend, they have a great person. So it's great to learn all that, but understand that is a very complicated, more complicated way of doing things. However, the way I would recommend most people to start off with as an investor is to actually avoid bad stocks rather than figure out what a good stock is.
Actually, yep.
Right, because there are only three kinds of outcomes in the market, right? Picking a stock. You pick a bad stock, a good stock, or a stock that does nothing.
Yep.
Right? So out of the three, if you remove a bad stock, you might think that your success or your chances of getting a good stock now is 50-50, right? Because from 3 options, you reduce to 2. Actually, you're not. What you've actually done is vastly increase the probability way above 50%. You know why? Because most stocks in the stock market are bad. So if you have the ability to scan and decipher what are good stocks and bad stocks.
Yeah, the remaining one will be
the probability. Exactly. So the probability becomes a lot higher to find good stocks or even the stocks that do nothing,
Yeah, okay, that's actually pretty interesting.
Right. So that's why I think we have this video here today to share with you what we think are some of the red flags, right?
Yeah. So
the first one.
So the first one is red flag number 1 is selling their core revenue driving assets. So there's an example for this. Over here. So if you didn't know, we actually did post this video up last year, December 2021. Yeah, and I was actually pretty bullish on Maybach initially.
Right.
And I think back then the share price was around like 70 cents or so. And then it went up a little bit, like 10% each, like around 80 cents, but I didn't sell it. So the reason why I was so bullish back then was that freight rates was actually going at all-time high. I mean, it has been on the winter. This industry has been on the winter for like decades. Like 10-20 years, long winter. And then finally, this kind of supply chain issue had drive a lot of these dry bulks revenue and even profitability up like tremendously, like two times to even 3 times.
Right.
And Maybach obviously also benefited from this growth. However, what they did opposite from their competitor was that they were actually selling their ships.
Right.
For profit, which actually it is also one of the strategy because they know that this industry is not gonna bring them big money in the future. So when they see this kind of opportunity arise, they start to like dispose all of their core assets, which is their dry bulk ships, in order to pay off their debt. And also, back then they didn't really disclose that they're gonna diversify in a new business, but right now it start to like emerge already. So Maybach is right now diversifying their business into like I would say like a supermarket kind of like business.
Oh, okay.
Yeah, which is a little bit more profitable, definitely more profitable than dry bulk business. But yeah, back then when I saw that they actually sell off all of these key revenue driving assets, I thought it was actually a good move. Because back then they weren't really making any money, but then because of that they made some money, but they are selling asset. So that's not really how they actually generate their actual operating income, I would say.
Yeah. Also, just to add, I mean, even if they were to diversify into something else, it's not easy, right? I mean, one, you're managing tankers. The next thing you're managing supermarkets.
Yeah,
Right?
yeah,
So it's
correct.
not going to be, I'm not saying it's impossible, obviously, but it's not going to be.
Yeah, they definitely need the cash on hand.
And I suspect that a lot of it is, I think they've suffered for so long, the industry, including Maybach, that the minute they see it jump, it's like, this is my exit, right?
Yeah.
And to be fair to them, it somewhat justified because they had that decline, right? The supply chain has managed to ease, which means that now transportation cost is going down. So these guys will...
Yeah, they're actually making the right move, actually. Yeah, which is different from the competitors. Because the competitors were actually busy building more ships. Exactly. Buying more ships. Yeah. So kudos to Maybach, but then to Maybach investors like me, sad. It's all good. Okay, so the second red flag we have here is follow the hype. Yeah.
Follow the hype. Okay, I think when people look at the picture, they already know what you're gonna say.
Yeah.
Right.
I mean, we pretty much have repeated this countless times in our past videos.
But it's okay, we always have new viewers, so we have to repeat it yet again.
So the first one is definitely gloves. I mean, back then, 2020, gloves was an easy making money company.
Yep.
Yeah, that everybody want to dive in. Even your auntie in the supermarket will just ask like, "Oi, you go buy Supermax or not? You go buy Top Glove?"
That's when you know. That's the top.
That's the top
of Top Glove.
Yeah, but the second picture is pretty interesting because right now everybody's talking about EV.
Oh yeah,
electric vehicle. Yeah. So definitely, I think it was in the I think early 2021. That was the peak where everybody like say EV is gonna be the next big thing, and then after that, definitely all things come to an end. They drop. Yeah. So I believe Tesla was, I think it's down like 50 or 60% from its all-time high.
I think it's maybe 40, 50 somewhere there.
Yeah. So definitely don't follow the hype. Yeah. When you see these kind of companies that start to diversify their business into something related to this, right?
Yeah.
You may want to dig out whether they really have the capability of.
Yeah, I think the key that you mentioned is the, following the hype.
Yes.
So to be very clear for those who are listening, we are not saying that the companies period in these industries are bad. What you're actually saying is that they're a company maybe from another industry suddenly get into this.
Yes, correct.
Right? So we are not like lumping necessarily, Tesla or even Genetech in Malaysia here or Top Glove. What we are saying is not following the hype.
Yes.
Right? However, just to add, I think this is also good feedback and criticism, constructive criticism of the companies who are already there, but chose to also follow a hype in the sense of building and expanding capacity.
Yep.
Right? Now, one thing is also important for investors to know is that although hype is typically bad, but there's what we call a kernel of truth to hypes. EV is the future.
Yep.
Gloves will still grow.
Yep.
Right? But valuation matters.
Yes.
And that's why I think...
And also execution also matters. Because if let's say a clothing company suddenly decide to go for EV, it's like, you're going to like, do they really have the expertise to actually do that kind of business? Yeah. So these are the things that you need to know.
But guys, before we move on, if you're someone looking to level up their stock investing skills and you need a lot more guidance, we do have a one-on-one program called the Mentorship Program. If you're interested, you can apply it in the comment section or the description.
Okay, and the third red flag we have here is unhealthy financials. This one, I don't think it needs a lot of explanation. If they have like a lot of debt, they raise a lot of money from the shareholders, they have bad cash flow. I mean, those are all kinds of signs that they have unhealthy financials.
Right.
And okay, the fourth point we have here is they stop innovating.
Right.
So I believe there's an example over here.
Classic.
Star Media. I mean, back in the days, everybody read newspaper, but as things start to go digitalized, I mean, definitely you need to start innovating, right? To like build your presence online. But I believe Star Media was too late in the game. Yeah, they didn't really capitalize on that opportunity when there's the internet has started to emerge, right? So emerge. So yeah.
If you think about it, it's so crazy that they're close to 200 million market cap. They're a small cap, for like the largest English paper.
Yeah, exactly. I mean, I believe back then they were around like 500 or more than that.
Yeah,
cap.
but if you calculate, right, all time,
Oh, it's
91%, right?
Yeah, so if you divide it.
So it's times 10. It used to be 2 billion. Right? You get the math right?
Yeah. A blue chip company.
Yeah, it used to be blue chip. Now it's, I don't know.
Yeah.
Very red lah.
Okay, the final one we have here is when companies' valuation don't make sense. I mean, this is actually very pretty straightforward. So to me, a current example that I have right now is Hexstar Technology.
Okay.
I cannot understand how a business that has been involved with like trading or building materials have such a high PE, like 100 times. And then, but they also did mention that they're going to diversify into tech, but there's no execution yet. I mean, not to say there's no execution, but there's nothing that we can see right now that they actually show that they are doing this tech business.
Right.
So yeah, I'm not sure why. Is it up like 10x in the span of 1 or 2 months? I mean, if you follow the company, right? Yeah.
And then the minute you say this and you post the video, it goes to 25.
Yeah. Could be. It could go either way. But
yeah. I mean, you're right. Like, again, right? Technology and investments, we like to think that we should invest in the best technologies. Like it sounds like it's so. It sounds true, No, it's not. It's true, right? You want to invest in the best people. You want to invest in the best technology, the best product, right? I mean, naturally, right? But the thing to consider as well, a huge thing actually, it's not just the thing or a thing. It is valuations can trump all this in importance. And the classic example that we like to use is Microsoft. Microsoft was fantastic. In the late 90s, they were growing at 30% every year revenue-wise. Stock price doing very well. So, but if you bought it in 1999, it took you 16 years to break even. That means in 17 years. In 2016, it was the same price as it was in 1999. But in that same period, Microsoft just keep doing better and better and better and better. And it's a very similar story with companies that are the Amazons, not the FANG stocks and all that. So like Tesla, I'm not saying this will happen, but you look at Tesla, right? It was a darling. It has done well. Like fundamentally, not just share price wise.
Yes.
It's down 40-50%. A lot of people say, well, it's a discount. Okay, perhaps you're right. But what if similarly to Microsoft, it takes 17 years for you to come back? Because it's not just the quality of your company, it's at what price you buy it at. And eventually, I believe Tesla will return back to its original price. Yeah. But there's really no one to say that it's going to be very soon.
Correct. They just need to keep on hitting those expectations. I mean, and at some point, they'll hit into a plateau and then... then you know how the story goes. Anyways, so that's about it. And yes, don't forget to check out FIRL Pro. We have a lot of good stuff over there. I believe we're now going to be having like 15 reports already as of this recording. And we haven't updated our portfolio yet, but at the end of December, you will see a new stock performance update. And
this is the FIRL Pro portfolio that, now you see ABCD, but if you sign up to the program, you will see the names as well.
Correct. So if you want to know what are the stuff inside, we actually have a free sample over here. Do check out. I mean, it's free, so you can just see how we write our report. We also do like write a big picture report. Basically, we tell you where the wind is blowing, how's the economy going to be growing in the future, and all those good stuff. So all of the links are in the description and comments.
Yeah, and guys, the reports, they're easy to read. They're not like 100, 200 page research reports. You only just need less than 50 minutes. It's a cup of coffee. It's very easy to read. It's designed for non-experts. So do check it out. Do check out the free sample, and I hope to see you actually in the program. And we also actually have a 10-day refund. So even if once you sign up, you don't like it, 10 days, you don't want it, no questions asked, we'll refund you. Well, we'll ask you why you want to refund, but that's about it, right? We'll definitely send you the refund. Now, guys, hope you enjoyed the video. As always, if you did, like, comment, subscribe, usual stuff, follow us on our social media, and I look forward to seeing you in our next video.